Hi, welcome back to Money, Money, Money. Kirtan Shah of Credence Wealth Management is still with us, and today we've been speaking about, the relationship between the global macros and what it does for people like you and me and our investments and portfolios, and why it's important to actually understand this relationship. So, Kirtan, we've spoken about, what's happened so far, what's happening now, and the impact on equity. But there are several other asset classes. So let's talk about bonds then. What has been the impact on bonds and how does it all come together?
So, Sumaira, while we talk about fixed income, first we have to understand the relationship between interest rates and the value of the bond. Right? And you would have heard a lot of us say that they are inversely proportional, right? What that means is if interest rates are going up, then any bond which is listed will fall in price, right? So let's say if today I issue a bond which is at 8% and issued to you at 100 rupees, if interest rate in the market goes up, right, I will still be making that same 8% and not the higher. Yeah. So my bond will start trading at 95, 90 in the market, and that's how they are inversely proportional. So what happened when the pandemic came was interest rates were slashed, and because interest rates were slashed, that worked out in advantage of the fixed income market. When interest rates went down, the value of those bonds went up. But what's been happening now is you see that globally interest rates are going up, right? You've seen US increase interest rates upward of 3%. India has done almost 190, 200 bips, right? You've seen UK do upwards of 2% interest rate hike, right? So now when interest rates are going up, you saw in 2021 that the fixed income market didn't really do very well because when rates went up, the value of the bond fell, right? And which is why you saw that the longer duration funds, like we call in the mutual fund space, they generated hardly 2-3% return the entire year, and you saw the liquid fund kind of category give you 4-4.5%. But largely last year they didn't do anything larger than that. Now what is happening is interest rates are going up. Central banks are trying to do the opposite of quantitative easing, which is quantitative tightening. They are sucking liquidity out of the system. And hence 2021 was not very favorable for fixed income. But now, specifically in the Indian context, Sumaira, I think we are very close to interest rates largely topping out, right? So we probably might have another 35 bips and then a 25 bip kind of rate hike that is expected, largely if things stay where they are, right? So now, while we are talking about fixed income, Sumaira, I think we are at a stage where the interest rates are kind of topping out in the Indian context, and now fixed income will behave slightly differently the way they did in 2021. So probably now is the time where interest rates might top out, and then you might see interest rates falling, and when interest rate starts falling, you would see bonds giving you capital gains, right? So this is probably the time to start focusing a little allocation towards fixed income.
Reviving
which didn't happen in 2021, Sumaira.
Okay, so we've got covered equity and fixed income. What about currency?
So Sumaira, so we've heard, while we spoke about other asset classes, currency was the most discussed topic globally in 2021 and 2022. Now, there are 2-3 aspects on currency that I think we should know of, right? First, we said that inflation is going up, right? Now, whenever inflation goes up, your commodity is becoming expensive. So today, if I'm able to buy, let's say, one pen with this 100 rupees, if there is inflation in the...
What pen are you buying? I'm just kidding.
So let's say if the same pen that we are talking about becomes 120, I'm largely saying that the 100 rupee value that it carried prior to the inflation, it does not carry right now, right? So we are saying largely when inflation goes up, your currency depreciates. And we saw that happening globally, right? We saw almost every currency except the Russian currency, if I'm not wrong, every currency is fallen versus the dollar, right? So whenever inflation goes up, your purchasing power goes down, and hence your currency will typically
the way we
fall.
like to say, the dollar has strengthened against every currency.
Yes, I very particularly didn't use that term is because there is too much of debate happening whether that's the right way to talk about it or not. But yes, look, largely when inflation...
Either way, that's the impact.
Yes, so largely when inflation goes up, you would see your currency depreciate. That's one. Second, also what happens is, Sumaira, when we spoke about central banks infusing a lot of liquidity, right? Now imagine if you just keep your printing press on and just keep printing the currency and distribute it to the market, your currency is not going to have the same value because there's too much of supply in the market. And this is also what happened because of which currencies depreciated largely globally, right? Of course, India's done a very good job versus global because our macros have been far superior than we spoke about inflation, right? It's not as big a problem as in India versus globally, or we've not printed as much money as the global central banks did, and hence our currency did very well versus the other global currencies. But largely what we are trying to say is whenever there is inflation, whenever there is so much of printing of money happens, your currency will depreciate. But to reiterate what you also made as a point, right? It is not more of what the Indian rupee did versus how strongly the dollar went up, right? So if you look at how dollar performed, right? You look at this index called DXY, which the dollar is mapped against 6 other hard or major currencies. You compare that index's movement versus our, you will understand that rupees hardly depreciated versus the way the other global currencies have depreciated. So we've done a good job. But largely the currency would typically fall in such a situation, Sumaira.
Understood. And it's Diwali, so we can't let you go without talking about gold. How has gold moved? How is gold related to all of these moving parts?
So, Sumaira, gold typically, in my opinion, gets affected because of 2 reasons. First is interest rate, right? Now, imagine a situation where interest rates are high, right? When interest rates are high, you have a very simple option of doing a fixed deposit, right? And why would you want to then try and experiment doing something outside of it, right? So when interest rates are high, money automatically starts flowing towards fixed income. And gold is not a very large preference at that time, right? So currently what is happening is interest rates are going up, and hence a lot of money can flow into equity. A lot of money flew into fixed income, but we didn't see a lot of money come into gold, and hence dollar returns, gold was minus 7%, right? The last 1 year that we are talking about, right? The other way of looking at it is dollar. So, Sumaira, internationally, gold trades in dollars, right? So, let's say if $1, 1 ounce of gold is $1, hypothetically, and $1 is 70 rupees, today you buy 1 ounce of gold, you will have to pay 70 local currency, right? But let's say internationally, 1 ounce is $1. Right? But $1 becomes 82, right? That means the landed cost of gold in India from 70 becomes 82, right? So the price of gold goes up, right? In the local currency. Now in this context, if I tell you the last 1 year, gold fell 7% in dollar terms. But in the rupee term, there was 4% appreciation, right? Because the rupee depreciated, right? So gold has a very large impact of where the currency also moves. So if you anticipate that the dollar is going to top out and there is not going to be a lot of depreciation in rupee going further, it might end up supporting the gold prices. Because interest rates have also topped out, and we are saying that probably dollar might also top out, and rupee depreciation might not be too strong. I think all of these things will probably support gold going forward, Sumaira.
No, absolutely, because, everybody who says that, over the last 20, 30 years, my gold has appreciated so much, but, had you held dollars in your hand, it would have appreciated just the same. Kirtan, thank you very much for your time today and for making us understand the relationship between the various moving parts that are there globally, which we know as asset classes, and how it impacts our investments. And, just to say that this is a theoretical explanation, but do keep your long-term portfolios mapped to your asset allocation. With that, we'll wind up on this edition of Money, Money, Money. Wish you a very happy Diwali and a prosperous new year.